Well, when was the last time you heard a semi-cheery prospect for St. Louis? That was wonderful, thank you. Next we have Emmett Wright. He is Chief Investment Officer of Northwestern Mutual Management Company. Prior to his current role, he held various positions at Merrill Lynch Investment Managers and Bank Boston, Fleet Boston. He's responsible for investment philosophy, investment process and strategy, as well as investment content for Northwestern Mutual Wealth Management. He also serves as the primary investment spokesperson for the company. Would you welcome Emmett Wright, please?
Thank you. All right. I'm usually the doom and gloom guy too, so it's going to be a little interesting. Maybe it's easy to start with kind of what our outlook is and really more around implementation, because that's what I spend my time doing, really taking the work that these folks and colleagues like them throughout the country do in the way of projecting and forecasting economic growth, inflation, all the variables that go into really making the investment decisions. And it certainly is a challenging environment. But I'd suggest the big takeaway is I think where we are right now is essentially, from an equity market perspective, we are still in a cyclical bull market that is buried within a secular bear market. And that bear market started back in roughly 1999-2000 with the popping of the internet bubble. And when we moved that bubble over into housing and the financial markets, and that bubble was burst, and now we've kind of kicked it over to the balance sheet of government, and eventually that's going to have to be reckoned with. But the good news is that when we do come out of this, this period of adjusting, I'd suggest, and I agree wholeheartedly with Alan's comments about a recession somewhere down the road, maybe 2013 or 14, that's hopefully going to be the catalyst for that be sort of the more normal cycle where the Fed is actually going in and probably raising interest rates because we've got some inflation in the pipeline. And then coming out of that, I actually am much more optimistic that that begins sort of the next secular bull market in equities, meaning a much longer time horizon, because things aren't that different this time around. The adjustment process is very uncomfortable, but the basic laws of finance still hold true, and that is, at the end of the day, after 20 years of bonds outperforming equities, finally, you're going to need to get compensated more for owning an equity, from owning a bond, from owning cash. And so there's some good news that's in there. Near term, I think it clearly is the uncertainty factor, and so much of that is driven around policy decisions and what's happening in Washington. So again, not to belabor the point, but businesses, large companies in particular, aren't spending because they don't know what it means to add capacity, to add additional employment. Likewise, small business owners, they're not taking the risk because they just don't know what's out there. And so hopefully through the political process, a lot of that gets resolved. And longer term, the political process is going to have to deal, obviously, with the structural debt that is out there, and that's a big theme. So near term, what we see is actually probably a pretty boring scenario in which things look very telegraphed for us from a capital markets perspective. And that is, the Fed is really controlling so much of what happens in the financial markets. And being that the economy is still so fragile in this stage of the recovery, they're not going to do anything to upset the apple cart, so to speak. So if you think about how their policy of openness is continuing, that they're leaking out the possibility of quantitative easing and preparing the markets for that, so the markets will do a lot of that indetermination. The Fed isn't going to throw a curveball. When they did that, if you think back to 1994, the Fed went in, unexpectedly raised rates in February of that year, and it caused a financial crisis. It caused a lot of derivatives to blow up. Orange County in California went bankrupt as a result. And what ensued from that was really that the Fed realized that they need to be a lot more transparent in what it is they're doing. And so you've seen that continuing through, and especially I think with this regime that's in place now, Bernanke knows that he has to have the confidence in the capital market participants. So as a result, they're going to do what they need to drive asset prices up. And that's what you're seeing. You're seeing all asset prices being inflated with the mere suggestion of quantitative easing. And as a result, what's happening? The dollar's going down. And so they're getting the desired effect. And so looking out, we actually see probably some very good returns through maybe the end of this year into early next year, largely as a result of that. Now, how they unwind it is going to be a whole different scenario, and what are they going to do, and what are we going to do about these deficits down the road? So let me jump into kind of some of the things that we're looking at. And again, I mentioned that near term, we've got these political issues that need to be resolved through the political process. But labor conditions certainly, again, are troublesome. If you think about domestically, right, GDP, let's simplify it, right, C plus I plus G, right, the consumer, business on the investment side, and government, right, those are the three components. Well, we know that we're a consumption-based society. The consumer is responsible for, 2/3, that's a famous euphemism, right, but consumers aren't spending, all right? They're not spending for two reasons. One, they don't have the houses, the ATM, and second, the labor markets are incredibly weak. There's a high degree correlation with the strong job market and with consumption. It's pretty simple. You've got a job, or you're feeling good about prospects for a better job or higher wages down the road, so you open your checkbook and you spend money. And so that's not happening. We did see some business investment last year. A lot of that was probably inventory recycling. We saw that, inventory restocking rather. And now we've got this uncertainty where companies are saying, you know what, at this stage of a recovery, normally my margins are good. I'm really going to be looking at a market share game. I want to make sure that I'm the last one standing. But everyone's looking at everyone else and saying, you know what, he's not doing it, I'm not doing it. Let me just see what all this means when it plays out, because I just don't understand. Is the government going to step in and start taking over my industry? What do these healthcare rules mean for me? I can't understand them. So you've got that factor. So that's really going to be problematic, I think, over the short run. So it's going to take us years to get out of that. In longer term, we talked about kind of the demographic issues. So while we're optimistic, you can see this is what Sell Street analysts are predicting for the next 12 months. Very, very optimistic. I'd suggest that if we get another, over the next 12 months, if we see maybe 8 to 9% returns, it'd be phenomenal. But I doubt that we're going to see this. And why? Because this is all sort of top-down analysis. They're looking at corporate profits, and they're trying to figure it out. But the reality is the markets don't really care, because the markets haven't been trading on fundamentals. They've been trading on these macro factors. So what's going on in the peripheral countries in the Eurozone? It matters, because the markets get spooked. You look at the volume on the exchanges. You're not seeing real investor activity. You're seeing a lot of hedge funds and a lot of ETFs go through the construction process, but you're not seeing a lot of money flow into the market. And so as a result, you're just seeing pretty much a trading range. But again, longer term, we think that the adjustment process will be fine. Oh, I'm not going to spend a lot of time on the job market. We don't really look at the unemployment rate per se. We care to look at payroll growth. So non-farm payroll comes out every month when the Labor Department releases the unemployment rate. And the bottom line is to get back to what is sort of a natural rate of employment. I'll put it in technical terms. You can see that the yellow line on the graph is looking at the average payroll growth each month over the past 40 plus years. And that's averaged roughly about 180,000 jobs a month being created. And you could see the big drop-off 2008, 2009. That's when corporate America essentially cut to the bone, bracing themselves for not a recessionary scenario, but a potential depressionary scenario. And they're not hiring back. We saw a little uptick, and that was mostly government workers, and now we're seeing that fade off. So not only are we losing census workers that are coming off the payrolls, a lot of that quote-unquote shovel-ready money in the $787 billion was really just a transfer payment to state and local municipalities to keep folks on the payroll. The reality is the Labor Department itself projects that for the second half of 2010, there's going to be 500,000 jobs lost at the state and local level, municipalities. And you're seeing it because they need to get their budgets in order. And so they've got the ability to raise taxes, but they also have to curtail some of the services. And so that's going to continue. 49 out of the 50 states have constitutional mandates for a balanced budget. So you saw what happened in California just now. I mean, folks will talk about, oh, someone's going to go under. You're going to have some pressure, I think, in some of the municipalities, but at least at the state level, they're going to be addressing these issues, and they're starting to address them. So we can't rely on the G of C plus I to really add anything. That's the bottom line. Maybe we get additional hiring at the federal level to maybe regulate some of these new programs that are being rolled out, but I think that would be modest. But you can't expect at the state level. So how is a consumer going to get back with a weak labor market? To get back to this natural rate of employment, that there we go, all right. To get back to that 180,000 plus jobs a month or real rate of employment, we need to see non-farm payroll growth of roughly 220,000 jobs each month, every month for the next 7 years without taking a break. And the reality is that's probably not going to happen. So we've got some challenges there. The other challenge I think around it is really that these claims are at elevated levels. So they're consistent, and why it feels not much like a recovery is they're consistent with levels that we saw in past recessions at the peaks. And we're not in a recession now. We're in recovery mode. So this is painful. The average duration of unemployment is outstanding. And what that means is other problems down the road. So we have folks that their skill set has become obsolete. Those jobs that they were in, they're gone. So they need to be retrained, or they're going to have to eventually find work at a much lower wage. So those are problems. Those are problems that we're going to have to deal with through society. And why? Because confidence is around jobs. Confidence leads to spending. Ergo, we need to see the labor markets improve rapidly. We talked about home sales. I'm not going to spend a lot of time. It looks like we're starting to bottom out, and that's good news. But a lot of that is really the result of, in some cases, it was the first-time homebuyer tax credit, and also it's kind of the purging of the inventories and certainly the foreclosure process as it's going. But when you look at new home sales, clearly the industry is still really severely challenged. So we're never going to get back to those levels that we saw pre-2008. But just getting back to sort of the average long-term rate of existing home sales, it's going to take us years to get out of that. So in our estimation, this deleveraging process that you hear about, that's really, the problem that we're facing. It took us 15 years to build up that amount of leverage in the system. We're only 2 years kind of through that delevering process, so we probably have another good 5+ years of it, and I think that time coincides with sort of maybe the next stage of a recessionary period, and again, maybe back to the old normal, and that is, slower growth rates, more modest growth rates, modest inflation, and rates of return in the capital markets that aren't supercharged by the amount of leverage that's in the system. So there's good things eventually going to take place. But really, when we look at it, it's really for the kids that are in the room and my son that I worry about, and it's the standard of living. And so we talked about debt as a percentage of GDP. Okay, so we're not Japan, where debt is 220% of GDP. So if we look at what's just held publicly here in the States, it's about 56% of GDP. It may be tough to see that in the background, but let's add in what foreigners own, and that total goes to roughly 88% of GDP. And then we've got to add in Fannie and Freddie, because essentially we're backstopping them now. And that brings us up to 134% of GDP. Add in state and local debt, and it brings us up to 154% of GDP. And actually it got quite depressing. I wasn't going to add any of the entitlements on top of that, but you get the point. Social Security, Medicare. So we can't sustain these budget deficits. What that's going to mean is essentially it's going to be a reduction in our standard of living, longer term, period. Foreign investors are going to demand a higher interest rate to own our debt, and that's going to be impacted through our currency rate, through a weaker dollar, and that's something that doesn't hit you over the head overnight. That is a standard of living decline. Economists refer to that as purchasing power parity, right? And so that's not a concept that most of us are familiar with. You don't turn CNBC on and see a ticker for PPP, right? Everyone knows what the VIX is now because it's a measure of volatility, but 4 years ago, most of the folks in this room probably never heard of the terminology, the VIX. Well, you're not going to see PPP on CNBC. You're going to wake up 10 years from now and decide it's time to go buy a new car, and instead of rolling down to the Cadillac dealership or the BMW dealership, you're going to be rolling down to the Tata dealership. Probably a very good car, but you're not going to be able to afford the car that you used to buy. And that's how standard of livings get impacted. So these deficits are serious issues. They need to be dealt with through spending cuts first and then reasonable pay down. I'm not going to look at it at the state and local level. That's even more depressing. So how are we dealing with it? How are we dealing with it? Well, we recognize there's actually some good there. Because again, a lot of these problems are germane to us as U.S. investors, citizens, business owners. And so some of these problems, again, have to be resolved through the political process. We don't have control over that. But we can look around and we can see great opportunities for investment. And one of those is really the reality is that the world's a much smaller place. So here that you can see that trade as a percentage of world output. It's phenomenal. This is a win-win game. This isn't a win-lose or a zero-sum game. Everybody wins by increased trade. So hopefully we don't get a lot of this talk of sort of more protectionism, the mini currency wars that we're starting to see. Certainly a concern as everyone's trying to export deflation around the world, so it's kind of a race to the bottom in many respects. But the reality is, longer term, these are good trends, so we've got to think about how we capture them. Likewise, we look at where the growth opportunities are. So here are sort of projections as to where growth is going to come on a global basis. The yellow line, think of that as essentially, that's the US, that's the Eurozone, maybe ex-Germany, and Japan. And we're kind of in the downswing, and the emerging economies are on the uptick. And the reality is China is going to surpass the US as the largest economy sometime 2016 to 2020. And so that's there, that's real. But also it's Brazil, it's India, it's Turkey. And the thing that we all have in common up here, kind of in this yellow line, is not only do we have demographics that are working against us, all the countries above, we've got aging populations that have entitlements out there. We're all laden with a lot of debt. And these countries are expanding with population and demographics that are a lot more favorable, and they've got much better handle on their budget situation. So they're running current account surpluses. They're not burdened with the debt that emerging economies were a decade ago or 15 years ago. So in sum, I think what we need to see is, again, I think continued saving on the part of consumers. We need to see the uncertainty come out so that businesses will invest and start creating jobs. Education and training, I think you've heard this theme. There's no doubt about it, that's the most important determinant, particularly for the students that are in the room. Your future, your opportunity set is really going to be directly related to the level of education and the quality of education that you experience, even more so than ever before. It's just going to be a much more challenging environment. And obviously we need less government spending. And there's no doubt about it. Again, you don't need to make this a political issue. It's pretty simple. Every dollar the government spends is essentially a governor on economic activity. It's not a productive use of resources. And then from an investment standpoint, very briefly, I'd suggest, there is an issue here of deflationary pressures that are still in the system. There's potential inflation down the road. There's certainly concerns about the US dollar longer term. So what are we doing about it? Within our equity portfolios, we recommend more exposure to dividend-paying stocks. We think dividends are going to be a bigger component of total return going forward, again, because of this sort of slower growth scenario. We also like certain sectors that actually have some pricing power. So be it in a deflationary environment, they're not forced to essentially reduce prices. And even with modest inflationary environment, they actually have some pricing power. So those sectors would be generally healthcare, consumer staples, and materials. We'd favor those instead of perhaps IT or consumer discretionary sectors. And even within there, companies that generate a lot more of their revenue from abroad than domestically. So even in the consumer discretionary sector, you want to own Coca-Cola versus Diet, that's what I drink, Dr. Pepper, all right, because of the revenue. Likewise, on the fixed income side, I think it's a little early to start thinking about shortening up because, again, the Fed is not going to do anything when it comes to raising rates for probably at least a year, and they will give the markets a heads up on that. They're not going to spook the markets. So I think it's a little premature to be sitting in cash earning roughly 5 basis points, but at the same time, I wouldn't be chasing yields. I think you need a lot more diversification, again, from some of these forces, inflationary and deflationary. So having exposure to TIPS, Treasury Inflation Protected Securities, having more international fixed income in your portfolio through perhaps some mutual funds so that you can essentially buffer any of the issues with the dollar, a weaker dollar, and benefit from that. Exposure to high yield in moderation, having exposure to mortgage-backed securities where there's, again, this incremental income stream will help returns. Likewise, we think that you need to allocate more to emerging markets, not because you're chasing, it's just that's where the growth opportunities are going to be for the next decade, the next 2 decades. And again, it's increasingly other parts of the world, not just the BRIC countries, Brazil, Russia, India, and China. So good diversification there. And finally, one recommendation that we started earlier this year was adding a modest amount of commodities to your portfolio through a diversified, broad approach. So not chasing after gold because you want to use it as a fiat surrogate currency, but rather we like having modest exposure to agriculture, metals, both precious and industrial, and energy. Because again, that can help you mildly in a deflationary environment. In an inflationary environment, it provides a reasonable hedge, not as good as tips, but still. And also, there is a global growth story that's going to continue for the next decade plus. So commodities are going to be in demand. It's not just gold, it's going to be copper, it's steel, wheat, corn. The rest of the world needs to eat, and we still have the breadbasket here. And I think it goes without saying when it comes to natural resources and energy in particular, that the rest of the world is going to need to import those commodities as well. So there's great opportunities. Domestically, we're going to have our challenges, but as investors, we can participate in all the good things that are happening elsewhere, and let's hope the political process kind of takes care of itself and cleans up a lot of this uncertainty. So I think that's it on the remarks. I'm going to grab a seat, and I think it's probably Q&A time.